Overtime. I'm Nicole Petallides. Today's guest has called for a 30% sell-off in the markets. In fact, she said that right here at the New York Stock Exchange desk, and that was back in September of 2024. Despite that call, she still sees opportunity amidst the volatility investors have dealt with so far this year in 2025. Joining me right now to dive into it all, Rebecca Walser, President, Walser Wealth Management. So glad you're here.
Thanks for having me, Nicole.
So you really shocked everybody last fall when you started talking about a 30% pullback. And of course we went a little higher after that, but you felt like things were shaping up in a negative way.
Yeah.
Sort of rewind to that time.
Yeah.
To where you are now.
Well, back in September, that was obviously pre-election, and so we had no idea which way it would go. But I had a feeling that if we went, with a change in direction, that the market would be really optimistic on a new Trump 2.0 administration, and that, optimism would carry through to the new year, but then we would start to see implementation of policy, and that's where the volatility would come in. Really, though, Nicole, the 30% pullback is really much more macroeconomically related to all of the currency that was printed post-coronavirus, like 2020 through, I would say, 2022, and really that currency truly being absorbed by the world economy, creating inflation, creating a new standard of, price that people don't understand. And then you have all of the real estate issues and impact on that, because we have so much real estate that has to even get refinanced in 2025, right. And interest rate policy and all of those things. So really what we're seeing is a global macroeconomic shift away from the West and the US European kind of dollar alliance to the east, and that really is more telling, along with geopolitical, potential actions. But obviously, with this new Trump administration, we've had a lot of volatility with all of his implementations.
So there's so much to digest here. I mean, the big picture here is you're concerned globally about the inflationary story here at home, the strength of the U.S. dollar or lack thereof, yep. and the competitive space.
Yes.
And you've seen people, let's say, running to gold.
Absolutely.
Right? You've mentioned that, and you talked about that some time ago. You talked about the paper versus the gold bars, and we've seen it soar since you started talking about that, and you still think there's room to the upside.
Absolutely. We've been gold bugs, really. I would say, well, I've always believed in gold and silver as a true hard asset class. But outside of that, as part of a portfolio, Nicole, I definitely think that gold is a stability factor when you're going through inflationary price, problems with inflation globally. And so what we're seeing, and then you also have the other impact that we didn't really talk about before was Basel III. So Basel III really talks and moves gold from tier 3 to tier 1 asset on the central bank's balance sheet. And so what that means is it leverages and gives them more opportunity to secure their reserves. And so that's an implementation that's been going on globally. We are having problems here in the United States implementing it because obviously the banks have pushed back and told Powell, we can't implement Basel III. So that is to be determined in the United States.
So still a gold bug.
Still, very much.
Still on board for the 30% pullback.
Yes.
Now, of course, in the first part of 2025, we were saying 10% plus. We saw corrections in the major averages. Is that the beginning of more to come?
Yeah, it's the beginning.
When does this happen, do you think?
Obviously the timing is all that matters. We've seen tit for tat reiterations from Trump's administration putting forth policies, and we've seen other countries respond to that policy, and then we'll see our country respond again, and that has to all be ironed out and get more smooth. That causes current volatility, as we know, but really it's not going to change the overall dynamic that we've just printed too much, too fast post-coronavirus, and the world is digesting that, and it has also caused realliances on currency globally that will not be undone. Like the fact that our dollar is now like 56% of Forex reserves and dropping at a speed that we haven't seen in ever, right, since 1944 Bretton Woods. It's a problem, Nicole. So people are thinking that AI, we had that whole AI kind of like frenzy, kind of reminds me of .com, really, and irrational exuberance. I would remind people of Alan Greenspan's wording. And the fact is that when you look at AI, does it have the runway? Does it have the capability capability. The truth is, it is new. It's revelation. It's revolutionary. You combine AI with quantum computing, cloud computing, data centers, robotics, and new algorithms, and you have the longest runway ever. Probably it's the fourth industrial revolution, but it's not yet monetized. And then you have things like DeepSeek coming in and undercutting American producers. That gives us a problem and a pause on how do we monetize AI to our fullest extent if China's going to be right there stealing our IP and doing it cheaper.
So this 30% call, are you sticking with that number?
I am.
So you're going to. So it's not 20. It's not 40. I mean, you're sort of still in this 30% range.
Yeah.
You know, the DeepSeek stuff. I've had people come on and say we'll all work together. It didn't really matter. It wasn't really clear. It was vague. But then there was something else that came out a week and a half later. I mean, I think we're going to have a lot of competition in this realm in monetizing AI. Is the AI trade going to still be alive? Because there are folks who tell me that, for example, Sam Stovall over at CFRA was saying the sectors that pulled back will be the ones to bounce back. He talked about tech, he talked about consumer discretionary. He felt that those would be ones that would bounce back. Would you agree at the time, whenever that bounce back is?
Yeah, so tech, I think that again, the runway is very long, but I disagree with anyone that doesn't understand the threat that China poses. China has white papers, publicly published white papers that their government, the CCP, that has written that talks about dethroning America as the global reserve currency and the global economy of the world. Like, they absolutely have a bullseye on our back, and everything they do, and I'm talking about to the very lowest policy levels. This is a country that we don't understand because we have just a completely different model, and they have a bullseye on the U.S. economy's back, and specifically the dollar. So there is no sharing or playing fair. They steal our IP. They will always steal our IP unless and until we absolutely prevent it. So you see, like, the Trump administration doing executive orders that basically says, or there are people that are in legislation that are trying to promulgate acts to say no more students from China, because China has passed a law that says any college students that come over to the United States have to act as a Chinese actor on the behalf of the CCP. So we have a lot of things going on right now, kind of under the surface with China, that's going to come to the surface.
So at this point, and you know, as you talk about the competition to the U.S. dollar, we think about the BRIC nations together that have been working to make their own currency. You talk about, you know, DeFi, when you look at Bitcoin and crypto, right?
Absolutely, yes.
Are you a crypto fan?
I am a huge crypto fan.
Do you like Bitcoin? Do you think Bitcoin goes higher?
I like everything that remains decentralized.
So when you look at Bitcoin and you see it at 80 or 90,000, I mean, it's been over 100,000. Where do you think Bitcoin goes?
I mean, I think long-term Bitcoin, the price action for Bitcoin, long-term runway, 5+ years, is unmeasurable. But the issue that we have is the fact that we have democratized it by putting it into ETFs. And so now people are not buying cold storage and they're not buying the Bitcoins directly. They're buying ETFs. That changes the game. And then the other thing that's happening is that you have, you know, actual central banks trying to get into it and literally create their own central bank, you know, stable coin or digital currency. And that's where we start to see a problem, because the entire thing, as I don't have to remind the audience, the entire thing for blockchain currency was to be DeFi, decentralized, not controlled by a central bank. So when the central banks are starting to get into the game, what they're realizing is their currency, their fiat currency game, is closing. The window is closing for that, which is what I've been talking about all along. And so they're starting to say, oh, we got to get into this blockchain game.
But you would still buy Bitcoin.
I would buy Bitcoin for a long-term hold, 5+ years.
Okay. Understood. I mean, we're going to get to some stock picks too that you think may have longevity, that are good for a portfolio. But just as we talk about the market here and the volatility, which you expect to continue, you expect still more of a sell-off. I mean, how will we know when we've really had this capitulation, when we've really sold off the 30%, when to step in and buy?
So it would be a lot better for us if it would be a fast situation, although it would be more painful. So, for example, I'll take you back to August of 2024, when we had the very first reverse carry trade with Japan, right? That is something that has not been totally unwound, not by a long stretch, and we could have an unwinding event that would be catastrophic. I'm not calling down catastrophe, but I am saying, Nicole, that given how underfunded our banking system is, the retraction of the M2 money supply, but let's just look at the bank reserves. If people don't understand, they think FDIC, 250,000, I'm protected, and they think, oh, I'm protected in this bank and that bank, and so is my husband, and so is my spouse. And let me just look at the FDIC balance sheet. Less than 2% of FDIC eligible reserves are actually held in reserve. So we don't have any ability to have any banking losses, any problems with refinancing. We are priced for nothing to go wrong, and anything that does go wrong could be a catalyst for a very big problem.
Is there any way that you'd feel comfortable sort of giving year-end targets? I mean, not specific numbers, but higher than where we are now, lower than where we are now?
I mean, I really did believe and still believe, and I thought my 30% estimate was pretty tight. So the fact that we've come down into correction territory, we still have quite a ways to go to get to the 30. I think that we're going to see, and I don't want people to misconstrue this and say, oh, well, we're going to have, we go into the spring usually with bullish, sentiment, and people start to get excited about the summer vacation, and they just buy, I don't know. But even if that happens, Nicole, that doesn't mean that the underlying fundamentals are solid. They're not. We have problems, and with the new administration and them putting their spin on everything, it's going to be a volatile year.
Right. So it's hard to say by year end
very hard
where
to
we'll
say.
Be, but you do expect that big sell-off.
I do.
And I guess we'll have, the capitulation point, what you're saying, there may be some sort of catalyst, and then we'll feel that. That's what capitulation is. I mean, you feel that fear and that pain and that panic, which we haven't really felt at all.
Right.
And, many people call the pullbacks that we've seen in the first quarter of 2025 just a little bit of normalization after 20% plus years.
And that's true.
Traders, I mean, sure, everybody likes to make money in their 401k and IRA, but the traders are somewhat comfortable with it as long as they're getting some volatility.
Absolutely.
And it's not all one way. So let's get to your picks here. As we take a look here at your first pick, we look at Meta, which is still a winner and one of the only mag names that has sort of held up over the long term. You think there could be upside potential for this name, right?
Yeah, Meta is, really such an interesting case study. So they're 20% off of all-time highs, but really they are the second largest procurer of all of NVIDIA's chips. People don't necessarily know that they are, super big on buying it. And what, Zuckerberg has committed to billions, hundreds of billions of dollars being invested into AI over the long haul. And what's really unique about Meta, Nicole, is think about Facebook for a second, right? You know how you get a little message that pops up and says, then, and it was a year ago, and that wants you to fill in the picture of now. And that's just the system and the programming that does it. Oh, it creates, you go on a vacation, you take a bunch of pictures, you get on the plane, there's like a little video that it's already created for you.
Yeah.
So Meta has this unique space into our personal lives that 6 degrees of separation knows who your associates are and your friends are, and has the ability to really leverage AI, and monetize it not on what we're seeing on the commercial space and an industrial kind of commercial application, but personally with, your cousin's over here likes this, and you're similar in that. So we think this product might, and just the digital advertising space is the future. And with this amount of personal, intimate knowledge that it has on people, it is going to be massive. And it's very unique because everything else is being commercialized on the AI space for commercial uses and not necessarily, individual personal uses.
Yeah, I saw that in your notes that you talked about the AI space, NVIDIA, second largest chip buyer. I mean, this is another sort of element that maybe people aren't thinking about.
They don't.
When it comes to Meta and all the things that are under the Meta umbrella. Just some final thoughts, because it is off the highs. It has had a tough 2025 for all stocks. I mean, it came off its high back in February that we saw 740 or so.
Yeah.
So, I mean, maybe you won't give targets, but you do see upside.
All of
and is it for 12 months?
Yeah, all of these picks are longer term, Nicole. Again, I expect overall, and you've seen the Mag 7, you've seen it. Meta obviously is held up, but Meta will trend down too. There is no pick that I have, there is no pick that exists except for maybe gold and silver that will not trend down as the market trends down. Like in other words, people don't look at Meta or Apple and say, oh, this stock is doing great, and even though the rest of the market's going to go, I'm going to go out and buy Apple. Now, people do buy on the dip, of course we know that, and that's obviously always something that people look at to incorporate into their strategy, but these are much longer term picks. We're saying, hey, through the volatility, these could give you some longer term price action to the upside.
Right, because generally, I mean, you gave us, just to circle back, folks, some names that you liked, but those were short-term plays.
Short-term.
We did see them pop
Yes.
or drop
Yes.
or have volatility.
Yes.
Some of those names that maybe people could continue to watch. You had Snap, you had Lockheed Martin, you had Fortinet, and Eli Lilly.
Yeah.
And maybe, I mean, I
Yeah,
don't
for
know if you
example,
have-
Eli Lilly, we recommended short term at 820. It went up to 875, and then it pulled back down to 8. It's like around 805
so you
right
got
now.
that run
so
up.
we got the pickup.
Right.
But people are like, but you picked. Well, yeah, because it was a short term recommendation. So
Yes.
get the pickup and short term price action. You have to execute fast. You'll get the growth fast, but then you can expect to have to maybe sell out of the position to capture the profit. Yeah.
Understood. All right. Next up, we have the trade desk, which hit a high back in December and then went down to new lows this year just recently. Maybe does that provide opportunity because you think fundamentally it's a great company and maybe got thrown baby out with the bathwater?
That's exactly what we think, Nicole. You hit the nail on the head. Sounds like you do this for a living. It's 60% off of its all-time highs, but it has beat expectations 32 out of 33 quarters. So this last quarter that you're specifically talking about, we think exactly that, out with the bathwater, really does have digital advertising, not to bring back up to Meta, but digital advertising is the future, and this is a technology that basically can cross platforms, and you can do all kinds of, interesting actual ad buying, optimize it, measuring it, and it's a really good company. Its price to sales is only 11x, which is like the lowest since 2018. So we think it's a good undervalued stock right now.
All right, and then Johnson & Johnson, which had a run up. I mean, from Christmas time, it ran up and then pulled back. So we've seen a lot of volatility in this name, but this has been a dividend. You always look for dividend payers, names over the decades. I mean, this one goes back old school.
Yeah, long-term buy, long-term hold. Like you said, the dividend is over 3%, so we're happy with that. What's really interesting about Johnson & Johnson is they have some, litigation that they have to still kind of get through that we're still going to see the impacts on. And also, they have like the whole healthcare division of like just if you go into the grocery store or the pharmacy and see how many products that Johnson & Johnson's actually responsible for creating, you'll understand. But they're also on the pharmaceutical side. They're the healthcare. They're really a solid healthcare pick. And long term, based on where they're at right now, we think that they're discounted and it's going to be a long-term hold.
Okay. That being said, we've heard from a lot of the retailers with concerns. We've heard from an earnings season upon us. We're going to be in the thick of it. We've heard from the airlines talking about maybe less domestic travel. The question is, will consumers feel uncomfortable this year?
Well, I think it's going to be what the headlines are saying, right? So consumer sentiment, University of Michigan, 3 months in a row, down, down, down. But why? And yeah, the market has retracted, so that obviously makes people nervous. But then you have all the headlines that are coming out that are saying, as the tariff policy was being implemented, Trump's tariffs are going to kill the market, kill the economy, kill this. And I just think that, it's so hyperbolic. It's so like everything's going to die. Yet when we had inflation, the Biden administration was able to, and not to get political, but the Biden administration somehow was able to get mainstream media to accept the fact that it was transitory for almost 18 months when it was clear you can't print that much money and have transitory inflation. But when the second that the new administration comes in and there's volatility, the sky is falling. So I think everyone needs to just step back, take time. Things are stabilizing as we're seeing, and that really is going to allow consumers to know where they're at. So right now you're seeing pullbacks, and people are not buying airlines. They're starting to save. We've seen the savings rate jump up immensely, and that really ties with the fear and greed index, Nicole. People are afraid right now.
When you're going to watch for earnings season now, what are you going to be watching for specifically?
I think,
is it different sectors that might tell you the story? Is it the language from the CEOs?
We are definitely looking at the earnings season. Necessarily itself shouldn't be a big surprise. Like we shouldn't see big pullbacks because it was too fast, right? But the forward guidance is where we're really going to understand what the companies, what these CEOs are really saying. Okay, this is the impact going forward, and I think that's where people will really start to feel, okay, if we get really solid guidance, if we get companies to come out and say, this happened, but it was a blip because of this, as long as we have guidance coming out showing people that yeah, we're seeing this kind of level out and stabilize. And it's really just about quantifying costs. You're seeing the M&A activity drop off completely off a cliff, but that's because nobody knew how to quantify the cost. Once everything is again able to be reduced to a mathematical formula, deals will get done.
So we talked about the competition, the U.S. versus other countries. You were concerned, of course, about China. You expressed those, some of those very, adamantly. At the same time, if you have China trying to dethrone the USA, which is your phrase, would you be buying China stocks, or are there international stocks, emerging market stocks? Do you look abroad in a portfolio now? I mean, and especially if you think, or you stay away from those stocks, or you can, plead the fifth. You can say that too. You don't have to say. I mean, you don't have to say I like to buy them or don't like to buy them. I mean,
Yeah. So with China, I would say that I would not want to bet against my country as a patriot. As an investor, I would say that China is going to give America a run for its money for the next at least 5 to 10. Like, we're going to have to get to some kind of resolution with China. Absolutely. So if you really are just looking for the place that you want to diversify dollars, then China is something that you would have to consider. Europe, I would say no, not a chance. And there's 2 reasons. One is they're really literally the 27 member states of the EU are trying their best to figure out how they can tax digital services, meaning they're trying to figure out how they can tax U.S. multinational tech giants like our Mag 7. And that is massive in there because they have got to get a new source of revenue. The other thing that Europe has done is they passed a law last May of 2024, and they have really, it is not yet, it takes a while for these things to be implemented, Nicole, but this is going to raise the cost of supply chains globally across every sector, every company, everything, and massively. And it is all about their green movement and moving to net zero carbon footprint. And it's just so stifling from a cost expectation that I would not invest in Europe knowing that this is coming under any circumstances right now.
Interesting, because that's a big call. I mean, I'd say a lot of people are still hot on Europe because Europe has outpaced the U.S., the stock market. You're saying no way, no how. Very interesting.
Longer term. You might be able to do better term, short term, but I'm talking longer term.
Look, you called 30% and we're down 10%. Right? Let's see what happens here. In the big picture here, and I was thinking about Europe, but the final thought is that you are a patriot. You still believe in the U.S. stock market. You gave us some big picks for long term. How about alt investing? I mean, would you consider, you mentioned gold, but real estate, or I don't know, watches or art, or, do you have a thought there?
So I'm a big real estate believer. I believe in real estate. I think that the market, or the sector specifically, that is going to be hammered is private credit. And, all of your collateralized loan obligations, your CLOs, mezzanine financing, this is where, we saw the dot-com crash. And
I was about to say, that was a problem back in the past.
The global financial correction, that was really subprime lending, and all of the securitized mortgages sold at, as bonds on Wall Street. So all of that this is where we're seeing private credit, mezzanine debt, collateralized loan obligations. We're going to have some problems with that. As the market turns, you're going to see that be the sector that really has some problems.
And will regular folks feel that? They may not necessarily understand that, but why will it matter to a regular investor?
Those are more hedge funds. Those are more accredited investors, institutional style investments. So I would say your average 401k investor, no. But if you've got a more sophisticated investor who is, is looking to Europe, looking to China, they're probably looking at what alternatives are in America, and they might have touched the alts.
What about dollar cost averaging and or cash?
I really believe in dollar cost averaging as a mathematical principle, and math is the love of my life. So I truly do believe that you should continue on your dollar cost averaging, and you really should only pause that under extreme circumstances. Like if the market really is crashing, you want to say, I'm not going to invest right now. But then you might see that as a buying opportunity because you never know when the bottom hits. So, for the most sanguine advice I can give about dollar cost averaging is stick with it through thick and thin, because that's the point.
And that's like the compounded dollar over the 10 years, the 20 years.
Yes, absolutely.
And to a retiree, what would you tell them?
To a retiree who does not have the ability to withstand any kind of substantial losses, they do need to look at the commodity space. And I'm not talking specifically about energy here, because what I understand with Trump's policy is...
Do you like energy?
I love energy on the longer term, because I do see right now we're in the 70-ish a barrel on crude, and what we're looking for is probably 60 to 65, because Trump's policy, he wants to make energy cheaper to offset any additional cost expenses with the policies implemented globally with tariffs. So we know that's where he wants to get savings, and so that means he has to make it cheaper by producing more, even potentially going off against OPEC and saying, I don't care that you're going to say we're going to produce less, we're going to produce more and make it cheaper.
All right. So then I guess you would like energy at the lower price. And
I would like it when we get to the 60, 65.
Right, understood. Last but not least, let's circle back to your big picture, and that was your 30% call. Being the math whiz that you are and the love of math that you have, I mean, when did you wake up and say, oh, we're going down, and we're going to go down 30%?
I think my position is really unique because I am on the managing money side, and I'm in the micro, of it. But I'm also so much tied to the global macro, Nicole. And there is a lesson for the world to learn, and that is that you cannot hyper-stimulate currency out of anything, and certainly not out of a global pandemic where you shut down globally the world for 3 to 6 to longer, depending on where you were, months. It can't happen. We cannot just print and fake fiat more and more and more and survive. So now we are going to deal with the repercussions of how much currency we printed, as well as the repercussions that we have 70-plus countries moving away from the West towards the East. And so that is the bigger thing that is happening overall.
And we'll continue to follow this story throughout the year. Thank you so much,
Thank you,
Rebecca
Nicole.
Walser. It's great to see you.
Thank you.
Rebecca Walser, President, Walser Wealth Management. And that will do it for this edition of Market Overtime. Be sure to like and subscribe to Schwab Network's YouTube page for the very latest financial news content. I'm Nicole Petallides. Thanks for watching.